Good afternoon, everybody, and welcome. I'm just going to wait for people to join. We've got people coming in at the moment, so just bear with us a minute. Okay, there's still people joining, so just hang on for 1 minute. Okay, I think we're good. I think we're good to start. So, as I say, good afternoon, everybody, and welcome to the first Intelligent Pensions Zoom webinar, which today is on the thorny issue of inheritance tax planning. So before we start, just a few housekeeping issues. First of all, I should introduce myself. My name is Andrew Penny. I'm the Managing Director at Intelligent Pensions. Unfortunately, today I have found two better qualified people to talk about inheritance tax planning than I can. So my job today is just to introduce them and to look after the Q&As as they go. And we've also got Donald Matheson, our IT manager, who is on standby, and his mobile number is on the screen at the moment. So if anybody is experiencing any particular issues, Donald is on hand to try and help where he can. If you can't get him on the mobile, you can reach him via the main contact number and somebody will put you through to him. And just for the benefit of doubt, anybody who's unfamiliar with webinars, you should be able to see and hear me, but we or nobody can see or hear you. So you're safe to pull faces, eat your dinner, you can do what you like because nobody will know. A couple of other bits. One thing, if you're looking for slides and you're perhaps not seeing it as well as you should do or at the size you should do, there is a view options at the top of your screen, and we've found that the fit to window tends to work the best if you're struggling, but you might need to try different options with different devices. The one way in which you can contact us today is through the Q&A. Tom, you just move that on one, and there should be a little button at the bottom, which is the Q&A, where you can ask questions, and I'll try and answer them as we go. They can be asked anonymously or just shared with the group. There should be time at the end to come to questions, and some people have kindly already sent me some questions, so we've got a few things to work with already. And last but not least, I did say this is the first webinar we've done in a long time. There will be, when you leave the seminar, the webinar, there will be a short survey, and it'd be great to get your feedback, just to get your views on how effective this is as a means to share and share communications and information, and what sort of subjects you'd like to cover or see covered in the future. So without further ado, let's move on to the main agenda, and I'm delighted to introduce Fiona Tate, our Technical and Compliance Director, who's going to go through the background of IHT. And she will then hand over to Tom Bostock, who is one of our chartered financial planners, who's carrying most of the brunt of today's presentation, for he is our IHT specialist. And then we'll come back to just how IP can help you, and some questions at the end we'll look to address. So without further ado, I'm going to hand over to Fiona.
Good afternoon, everybody. Welcome to this first webinar. My normal role as technical director is in the area of pensions, but we've decided to go with IHT today. And one of the things we want to demonstrate is really how Intelligent Pensions has expanded its expertise by bringing in such people as Tom and the extra services that we're able to offer to you. In relation to this particular quote, IHT is the one area where the two things kind of happen at the same time. And we can help you with the taxes side. I'm afraid when it comes to death, that's pretty much there. And there's not a lot we can do about that. But we certainly help you as much as we can with the second one. Ooh, there we go. So inheritance tax has been around actually for since something around about 1696. Like all other taxes, it came into being when we were at war with somebody or other and finance was needed for the government, and it's gone through various iterations since then. They haven't really been able to make up their mind whether or not they wanted to tax the estate or tax the individuals who are receiving it. But as of 1986, Nigel Lawson came along and changed everything. It is now in inheritance tax, and it is levied on the estate. And the idea, of course, and the perception that everybody has with inheritance tax is that it's meant to be a tax on the wealthy. So it's interesting to see that the definition of wealthy back in 1996 was £71,000. That has changed since then, as reflected in the nil rate band, and Tom will discuss the nil rate band in more detail. But basically, below that level, you are not considered rich enough to have to pay inheritance tax. So it started at £71,000, and since then it's gone up and up and up. And where there's also been an additional bit added onto it, recognizing how important property is as part of people's estates. So we're at a position now where the nil rate band is 325,000 per individual, and the residence nil rate band, more of that later, brings you up to a total of 500 per individual. And if you are part of a legally joined couple, then you potentially have both of those allowances. So you're not considered rich until you have £1 million. And we'll look at ways that we can try and get around that going forwards. Despite the fact that that definition has been going up, you may have seen in the press, the other thing that is definitely going up is the amount of money that the government is getting back from us in the form of inheritance tax. It's actually not one of their bigger receipts, but it is growing. And this is an overview since 1986 of how many millions the government have been managing to, I'm trying to use a positive word, managing to levy from us since the beginning of inheritance tax. And it's only going in one direction. There's a little sort of dip there, and that was when they brought in the ability to transfer your nil rate band. Other than that, it's going up and up and up. And the receipts in 2022, that's the last year that we've got. That's only half the year. If we got the same sort of level of receipts in the second half of 2022, then we'd be looking at a really quite significant sum going into the government's coffers and helping them to pay for everything that they need to pay. Apologies, by the way, for keeping Nigel Lawson's picture up there, but it's probably fairly relevant. It's better than looking at Andy Penny's picture, so I would just go with it. Okay, so summarizing basically the background of inheritance tax, the good news is very, very few estates actually pay IHT. It's always been around about 4% of the number of estates that are actually arising as a result of death in the UK. It hovers around about there, 3.73 in 2021, which is the last set of figures we've got. So you might think you'd be unlucky to be one of these people. However, the bad news is if you're one of our clients, we are doing everything we can to make sure that you are one of those people. And if you fall into that category, then I'm afraid to say the bill is likely to be pretty high. The average inheritance tax bill going in 2000 and 2021 was £214,000, and that is £214,000 that obviously we'd all rather not pay, or if I'm being absolutely technically precise, you won't be paying it, but your beneficiaries will, and if you're bothered about them, then you might want to consider some of the solutions that Tom is going to talk about just now. Now, I'm going to leave it at that, and I'm going to pass over to Tom, and he will give you more details. But if there are any questions, I'm more than happy to take anything that falls within my remit. Thank you very much.
Tom, you're on mute. Oh, the old Zoom problem.
Fell at the first hurdle. Apologies, everybody. So I will be running through the basic mechanics of IHT, how it operates, how estates are valued, and then we'll go on to consider some high-level strategies that can be used to mitigate inheritance tax, try to reduce an inheritance tax liability, and just look at those in some very high-level detail. I'm not going into too much detail because they can get quite complicated quite quickly, but we'll do our best to just give an indication of the steps that can be taken. And as Fiona mentioned, we'll look to pick up any questions that come about following on from that. So high level, easy starting point, inheritance tax is charged in the event of death. However, there are a number of scenarios where it is not necessarily instantly applicable. And the main one, especially in the case of first death, the main one is that when an estate is left to a spouse, there's no inheritance tax between spouses. So on first death, most of the time, inheritance tax is not an issue. It subsequently becomes an issue on second death. Equally, as Fiona touched on, there's the nil rate band, which we'll look at in a bit more detail in a second. So inheritance tax only becomes payable on second death when total assets exceed the available nil rate band. And in addition to that, there's also the residence nil rate band, which we'll come on to explore how that works in a second. Equally, the big one, particularly from our point of view, where we look after pension funds for the vast majority of our clients, is that pension funds are exempt from IHT and sit outside the loop of inheritance tax. So that's quite a key point when we're speaking to our clients about a potential income strategy in retirement, to think about, is income coming from pensions or maybe other assets such as savings or investments that might be available. So that's just something that we're constantly thinking about and considering when putting together retirement plans for our clients. So let's look at the nil rate band in a bit more detail. As Fiona mentioned, the standard nil rate band has risen since it was introduced many moons ago to the current level of £325,000 for an individual and £650,000 for a couple. So on second death, we'll come on to think about some circumstances in a second, but on second death, when an estate is below £650,000, there is no inheritance tax to pay. If the will dictates that on first death assets pass to the spouse, i.e. that nil rate band is not used by the first partner to pass away, the surviving partner can then inherit the full nil rate band as well. So if the £325,000 is not used in the event of first death, that simply passes on to the surviving partner. So there are the double nil rate band, the full nil rate band that can be set aside on first death. The instance where that might not occur is that if a will dictates that on the first death there is a specific gift to be left in the event of the first spouse to pass away, and in that case that would use some of that nil rate band, but that's probably the exception rather than the rule. And in the majority of cases we see the unused nil rate band passes to the surviving spouse. And then any assets valued within the estate in excess of the nil rate band and the residence nil rate band that we'll come on to in a second, tax is due at 40%. And I imagine most people are aware of that. I imagine that's not news to many people. So inheriting the nil rate band, so a high level example here, Steve and Claire have combined assets of 1.2 million. So that's property. We're excluding pension funds in this instance. We're talking about IHT-able assets. So combined assets of 1.2 million, and Steve passes away first and his will dictates that everything is left to Claire. So in this case, there's no inheritance tax to pay on first death because the spousal exemption applies and everything simply passes over to the widow, the surviving spouse. Claire then dies 5 years later, and when Claire, everything passed over to Claire, she also inherited Steve's unused nil rate band. So Claire has double full available nil rate band, and the estate now valued at 1.4 million, and there's an IHT bill of 40% on the excess over the available nil rate band. So in this case, £400,000 above the combined residence nil rate band would see a tax charge of £160,000 payable by the executors as part of the probate process on Claire's subsequent second death. And just a little caveat that £1 million double residence nil rate band, we're assuming here that everything passes down to children, which we'll come on to look at now with respect to the residence nil rate band. So the key point here is, as the name would suggest, there has to be a main residence that's left as part of an estate. And secondly, it has to be left to direct descendants. So 99% of the time we're talking about children. If an estate is left to nieces and nephews or wider family or friends, anyone that's not a direct descendant, the residence nil rate band does not apply. So it's only where there's a property, a main residence involved, and it's left to direct descendants. And in this case, each individual gets an additional £175,000 of tax-free assets that can be left without inheritance tax being payable. So that rounds the individual number up nicely to £500,000 each. Between a couple, it's an additional £350,000 each that takes the total available residence nil rate band to £1 million. So 2 times the original nil rate band is £650,000. 2 times the residence nil rate band is £350,000. So that gives us a total available residence nil rate band of £1 million. However, we do need to be aware that for very large estates, that this residence allowance is taken away. So it was introduced to, as Fiona touched on earlier, inheritance tax is historically designed to be a tax on the wealthy. But as house prices have soared over the past 20 years or so, more and more people were getting caught by, or more and more estates, I should say, were getting caught by the residence nil rate band, who may not be traditionally wealthy people with huge savings and investments. So you could have someone with a modest pension fund, maybe living off the state pension plus a modest pension fund, who happens to live somewhere in the southeast with a house of £1 million. So all of a sudden they start to be pushed into the inheritance tax trap, which is where this residence allowance was introduced. But due to that purpose that it was introduced for, it is then removed for very wealthy individuals and larger estates. So when the total value of assets, again excluding pension funds, when the total value of assets exceeds £2 million, the residence allowance, the additional 350 each, sorry, the additional 350 for a couple, is removed at a rate of £2 for every £1 that the estate exceeds £2 million. So essentially it's removed at a rate of 50% of whatever the excess estate above £2 million might be, which means that when an estate is over 2.7 million, that residence allowance is lost completely. And in that case, the basic nil rate band applies at that level. Where it gets a little bit complicated is estates between 2 to 2.7 million. There'll be a slightly weird number for a residence allowance in there. That's where the allowance is partially removed, and we have to look at it carefully to work out what the potential residence allowance might be. But the key figure there to be aware of is that 2 million figure is where it starts to be removed for estates excluding pension funds. Value in estate, it's fairly straightforward. As I say, everything that an individual may own, yes, more often than not assessed on second death. So we're talking properties, maybe second properties, savings, investment funds, ISAs, whatever it might be, with some exceptions there that we can see in front of us in terms of pension funds being the key one that we talk about a lot. But there are also some other assets that also qualify as an exempt assets from an inheritance tax perspective. We'll come into look at these in a bit more detail, but there's something called business relief. So certain investments can qualify for business relief, but also assets held within maybe a family business can be exempt from inheritance tax. Equally, agricultural land and farmland can be exempt. We don't tend to come across that too often, but it is there as an exemption that we have to bear in mind. And if there is any debt on an estate that's still current when individuals pass away, maybe a later life mortgage or something like that, that is deducted from the value of an estate to calculate the inheritance tax position. So just to look at an example in a bit more detail, an example here with an individual on second death, where there's a property worth either a single or multiple properties worth £1.5 million, maybe savings of £100,000 in the bank, £200,000 of investment. Chattels is one I should have mentioned. So that's just bits and pieces that might be around the house. For most people, maybe that doesn't add up to a huge amount, but if someone maybe happens to have a jewelry collection or some artwork on the walls that are worth some money, that would fall into that category there, and maybe motor vehicles as well. So really just to kind of cover the point that everything an individual owns gets caught by inheritance tax, other than the exempt assets we touched on. So in this case, we have a total estate. We can see we've ignored pensions in this case there on the right-hand side, a total estate of 1.89 million. It's not above the £2 million bracket. So we have a full double residence nil rate band allowance. And in that scenario, we have an inheritance tax liability of £356,000. So 1.89 minus the £1 million double residence allowance at 40% of that excess gets us to £356,000. Okay. And just to confirm that the pension funds, whatever value they might be, this is not truly to scale, or this is just put in as a reference point, but those pension funds sit outside of that loop. Don't get caught by that equation. So let's come on to consider some high-level options for potential how to reduce an inheritance tax liability. As Fiona mentioned, it's the one tax that all of us individually will never pay, but nevertheless, the thought of large amounts of money, if I just go back to the previous example, the thoughts of large amounts of money going to the revenue, whilst it's something we won't pay ourselves, quite often when we're speaking to clients, they look at large numbers like that going to the taxman and maybe think, well, the taxman's had plenty during my lifetime already, thanks very much. So that's where coming on to think about the options for possible mitigation really come into play. So the first one's nice and straightforward. It doesn't really involve a huge amount of technical planning. It's simply gifting money, direct gifts. And you see, these are referred to from a financial planning perspective as PETs, a potentially exempt transfer of assets. And I'll come on to look at that in a bit more detail. But essentially here, we're thinking about gifting assets, gifting funds, gifting capital directly to individuals. Something important to be aware of here is that there is an annual exempt amount that does not need to be registered from an inheritance tax perspective. And that is £3,000 per individual per year can be gifted with no record keeping required in order to think about potentially when that might fall out of estate. So there's £3,000 per individual, £6,000 for a couple, and then that can also be backdated 1 year as well if that hasn't been used in the previous year. But direct gifts, that is quite often a starting point, and maybe people like to think about helping children or potentially grandchildren with things like property is the common one that we come to talk about. But equally, in later life, we find that if we're speaking to people in the later years of retirement, perhaps they've already been through that cycle and they're still faced with an inheritance tax liability. The other consideration about direct gifts and gifting funds directly to beneficiaries who may be relatively young is the issue of control. So particularly if we're thinking about large financial gifts, is the recipient in a position to be responsible with that money? And that is the most common concern and question that may come around when we're talking about direct gifts. And that leads us on to think about the use of trusts. So trusts can be used, and we'll come on to explore the types of trust in a second, but essentially gifting money into trusts operates similarly to gifting money directly or gifting funds out of your estate. When you gift money into a trust, it is no longer yours, it's gone out of your estate. But the big benefit of the use of trusts is that no beneficiary, in certain types of trust at least, the beneficiaries can't demand access to those funds. They can't say, I want my money, please. The trustees retain control of those funds. So the use of trust is kind of the logical next step moving along when there may be concerns around gifting significant funds directly to beneficiaries. Outside of that, there are a couple of other high-level areas to think about. One is insuring against the liability. So we can do some analysis to think about, project forward 10, 15, 20 years, whatever it might be, to think about what a potential inheritance tax liability might be. And there are certain insurance policies that are designed to pay out on death to cover a projected future inheritance tax liability. And that's something called a whole of life policy. That's the abbreviation I've put in there, a whole of life insurance policy. It's not a term policy. It's likely, I have a term policy in place for my mortgage that runs for a specific term, but a whole of life policy is guaranteed to pay out on death whenever that might occur, be it 2 years, 5 years, 20 years in the future, that whole of life policy will pay out. And those funds that are paid out, the premium, that's the insurance amount that's paid out on death, can be used by beneficiaries to meet some, or in some cases, all of the inheritance tax liability. The issue we find in this world, however, is that those policies are very costly because there is a guarantee that they will pay out. So I've been dealing with these kind of things for the past 10 years or so, and I've seen some pretty hefty premiums quoted for these policies. And additionally, not only are they expensive, they only pay out if those premiums are paid for life. So sometimes someone might have 20-year life expectancy, though that high level premium needs to be paid every year, otherwise the policy becomes invalid. So there are some issues on the insurance side of things. Finally, then we have exempt assets, touched on earlier. We've got it used to be called business property relief. The formal name is now actually business relief, but many people still refer to it as business property relief. And that, as I mentioned earlier, was introduced to allow family businesses to pass down without getting clobbered by inheritance tax. But equally, it can apply to some other types of investments as well. There are certain share portfolios, for example, that might qualify for business relief. And indeed, there are certain investments that are targeted specifically in this area so that assets fall outside of inheritance tax. The key point being here in the realm of business relief is that any investments that do qualify in that space have to be held for 2 years before falling out of the inheritance tax loop. And this is something that I've dealt with a lot in the past, and we're in a place to now advise our clients on these kind of investment structures. And as I say, the main benefit of these is that 2-year qualifying window versus gifting money directly or gifting into a trust, for example. We're in the 7-year territory that I'm sure many people are familiar with, where gifts fall out of the loop of inheritance tax after 7 years, which we'll look at in a bit more detail in a second. So high level, we have option of gifting funds directly. If the issue of control and responsibility is a concern, that's where trusts can play a role. Insurance is an option, but can be very expensive. And then exempt assets and the use of business relief can be attractive, particularly maybe for more elderly clients, where the typical routes of 7-year gifting to get funds out of an estate, the benefit of a business relief portfolio is that it's a 2-year window rather than a 7-year window. So just coming on to look at the kind of principal types of trust in a bit more detail. On a very high level, there are lots of intricacies about how trusts can be set up. They don't need to be as complex as some people often think they are. But on a high level, there are 2 types of trusts. There's something called a bare trust or an absolute trust. And these trusts that are specifically for a named individual. Okay, they're quite often set up for minors. So we often see grandparents maybe setting relatively small investments up for grandchildren, and they can be placed into a bare trust. And it means that those funds are leaving maybe the grandparents' estate. They're gifted out of the estate and they're held on trust for a grandchild, for example. The big issue to be aware of within a bare trust is that the beneficiary has the right to that money when they turn 18. So this comes back to the issue of control and responsibility, and particularly depending on what level of funding we're talking about into these trusts. If the individual is aware of that money, they have the right to it, whether they're aware of it or not. So if they are aware of it, there might be an issue of control there. I'm not sure, if in receiving large amounts of money on an 18th birthday would present some issues or not. And just to complete a couple of points on there, those funds, as long as they're sat within a bare trust, are treated as if they belong to the beneficiary. So they have the individual, well, even though it's a minor, they'd still have tax allowances as if the gains and the income were taxed on that individual themselves. So again, if we're concerned with the issue of responsibility with the beneficiary being able to claim the funds at 18, demand the funds at 18, that's when we move into this world of discretionary trusts. And these are the more, particularly for larger amounts of money, where we're doing some more kind of bespoke, detailed inheritance tax planning. Discretionary trusts can play a key role, because here no one individual has a right to demand money from these trusts. So funds can be placed into trust. Those funds are controlled by the trustees, and they're nominated by the person who sets the trust up. But no one can at any stage say, I'd like my share, thanks very much, I want to go traveling the world, or whatever it might be. Only distributions are made out of those trusts at the trustees' discretion. So the trustee is responsible for those funds, and then we can see there trustees decide who benefits and when. We'll come on to think about this differences in how these trusts operate and how funds into them are treated. But just key takeaway that bare absolute trusts are for someone specifically, the hint in the name absolute. Discretionary trust has discretion over who may benefit from those funds in the long term. In terms of the types of trusts we can use, as I say, trusts can be as simple or as complicated as they need to be, really, and they still can be quite simple to achieve quite positive outcomes. So we've got some high-level objectives here, and if an individual simply has a significant estate, maybe significant amounts in savings or investments, those funds can be gifted into trust in a straightforward gift trust. Don't need to attach anything special to that trust. It is just a separate legal entity where funds leave the individual, placed into trust, and then they are managed for the beneficiaries. The key point about these kind of entry-level trusts, if you like, the straightforward discretionary trust, is that the person putting money in is called the settlor, which we'll look at it in a second. The settlor, the person creating the trust and funding the trust, they can never have that money back. So it's a very important part of our conversations with clients when we're looking at these kind of things, is to say, any money you're parking in that trust, are you comfortable that you have no right to ever have an income back from that or capital back from that? So it is an outright gift. We can see there are some options where you can have capital back. So for example, if somebody was keen to try and reduce an inheritance tax liability, but wanted to have the option to draw an income or capital back from the trust, there's something called a loan trust. And these are some really interesting examples where we use these in the past, where you can set up a trust with a loan, almost like a director's loan into a business. You loan money into trust. It doesn't have the immediate kind of short-term benefits that a straightforward gift trust does, but you loan money into a trust. And over time, you have the choice to either have that repaid as installments, as repayments of the loan, or you can write off the loan that then passes into a gift trust for beneficiaries. So there's a bit of flexibility there. I'd suggest these types of loan trusts tend to lend themselves to longer term planning because they don't fit into the 7-year rule, where a straightforward gift trust fits into a 7-year rule where assets fall out of the estate after 7 years. But loan trust just gives some ongoing flexibility and can work very well in certain circumstances. And then finally, where there is a known need for an ongoing income, no need for capital back, but a definite need for ongoing income, we can look at something called a discounted gift trust. And again, it get a bit technical and a bit jargony, but essentially with a discounted gift trust, the settlor who puts money into the trust can receive a fixed income back to them for the rest of their life. No flexibility, so that income is fixed at outset and cannot change. The big benefit for these kinds of trusts is that they can offer an immediate day one IHT reduction. And we won't go into too much detail here, but essentially these are underwritten on a medical basis, and based on an individual's life expectancy, their income over that period is essentially deducted from the amount of gift. So it gives them day one inheritance tax saving, but I won't get into too much detail there because it gets pretty complicated pretty quickly. But that's the kind of thing, obviously, we'd be more than happy to pick up with conversations with anybody that wanted to explore these things further. So gift trust, straightforward gifts, no access to capital. Loan trust gives flexibility. Discounted gift trusts give a set income and some day one IHT reductions as well. Quick high level, as I mentioned, the settlor is the person that sets up the trust, puts the money into trust, signs the paperwork, transfers the funds into a trust portfolio. They then nominate the trustees, and the settlor themselves is very much likely to be a trustee. So it might be husband and wife and maybe a trusted friend or family member, because the trustees are then responsible for the ongoing advisors would manage the funds, but the trustees make decisions about distributions and agree investment strategies and things like that. So the trustees essentially are responsible for the funds, but they don't necessarily have access to those funds, depending on what type of trust it is. And then finally, there are the beneficiaries that the trustees decide as and when the beneficiaries get capital or income is distributed from the trust to the beneficiary. And as I mentioned, within the discretionary trust world, the beneficiaries have no absolute right to those funds at any stage. Okay. Just a bit more detail here in terms of, I touched on this subject of pets earlier, this phrase that we use called a potentially exempt transfer. And pets cover direct gifts to individuals, as we saw earlier, but they also, any gift into a bear trust is also treated as a pet. And in the world of pets, a potentially exempt transfer, there is no limit to the amount of funds that can be gifted. So very wealthy people can gift significant amounts to individuals with no limit, subject to the 7-year rule where any gifts would fall out of their estate after 7 years. However, we go back to the problem we touched on earlier, where gifting significant amounts directly, again, raises the issue of control and responsibility. Okay. The reason it's called a potentially exempt transfer is because this 7-year period is the amount that gift into trust or to an individual directly is still potentially liable to inheritance tax. So if somebody were to gift £200,000 to their son or daughter, there's a 7-year window where that £200,000 is still liable to come back into the inheritance tax loop. Okay. And if they were to pass away within that 7-year window, that pet, what we call it, fails, that potentially exempt transfer fails, and that £200,000 comes back into the loop of inheritance tax and comes back into the inheritance tax calculation. I'm sure some people on this call have heard of the potential for that failed pet to be tapered down between years 3 and year 7. So once you're past the 3-year window, there is potential for taper relief to apply to the taxation of that gift. a key point to note is the taper relief does not reduce the value of the gift. It just reduces the value of any tax that might be payable on that gift. So quite often, if the gift made, for example, was within a nil rate band, the full value of that gift uses up the nil rate band, and then taper does not apply at all. It's only when the failed pet exceeds the nil rate band that the taper relief applies. But again, this gets pretty complex pretty quickly, and that's what we try to guide clients through this process, because we certainly don't expect people to know the intricacies of how these things operate on a day-to-day basis. So that's pets. No limit on the funds that can be gifted, but again, we have the issue of control if we're looking to get large amounts of money out of an estate. So then we're going back to the world of discretionary trusts, where, as I said earlier, no beneficiaries have the right to those funds. They're held on trust, controlled by the trustees. And in this case, rather than treated as a pet, a gift into a discretionary trust is called a chargeable lifetime transfer. Okay. And we need to pay close attention to these, because there is potential, if there's very large gifts made into a discretionary trust, for lifetime IHT to be paid. So when we mentioned earlier that nobody will ever pay IHT themselves, if you do make a considerable gift into trust, a very large gift into trust, a discretionary trust, there is potential for a lifetime IHT charge. And this is where the nil rate band comes back into play. So the residence nil rate band is irrelevant here. We're just focusing on the basic nil rate band. And the nil rate band, £325,000 per individual, that governs what can be gifted into a discretionary trust before a tax charge applies. So we can see there, if the gift is above the available nil rate band, there is a 20% lifetime IHT charge. So just working on some easy numbers for a single individual, if they were to gift £425,000 into a gift trust, the available nil rate band is 325, so they've got £100,000 excess has gone into a discretionary trust. There'd be a £20,000 tax charge on that gift into trust. And quite simply, as advisors, we would never advise anybody, or generically, we would never advise anybody to put more than the available nil rate band into a discretionary trust, because why would you're essentially choosing to pay a tax charge if you do that. Again, gifts fall out of consideration after 7 years, and when working with very wealthy individuals, it's possible to repeat this process every 7 years. So technically, between a couple, you could do a gift of £650,000 into trust. Between a couple, 325 each, £650,000 into a discretionary trust, where trustees retain complete control. The individuals can retain complete control as trustees. No one has a right to those funds. After 7 years, those funds fall out of consideration, and then that process can be repeated again every 7 years. Essentially, every 7 years, that nil rate band renews, and the process can be repeated again. So that's probably all we've really got time for, to kind of give that high level summary of the kind of the mechanics of inheritance tax, how the residence allowances work, some high level ideas about mitigation strategies. So those 4 high level strategies of direct gifting, gifting into trust, whole of life insurance, and the use of exempt assets and business relief. It can get pretty complex pretty quickly, and obviously we'd be delighted to pick up conversations with anybody who wants to explore that in more detail. But I think for now, we just wanted to give that high level summary. So try and give a good overview of the mechanics of inheritance tax. So it's important to know about, the operation of the nil rate band, which is, say, basic 325, 650 for a couple, increasing to £1 million where there's the residence nil rate band applies, passing down to direct descendants. One takeaway as well, just be mindful of that £2 million banner where the residence allowance starts to be removed. Okay, as we touched on already, just now, the high-level mitigation strategies of gifting and trust and exempt assets. And of course, as I mentioned, we'd be delighted to explore these in any more detail and answer any questions you might have. With which, actually, yeah, sorry, I'll just touch on this as well. I thought we were going to questions, but I'm getting one slightly ahead of myself. So in terms of how we can help here and how we try to guide our clients through this process, that, a key starting point of any of this is to do a pretty thorough analysis of an individual's financial position, assess their immediate and potential projected liability to inheritance tax. And we have some lovely software, I'm sure existing clients who are on this call would have seen our kind of cash flow projection software that takes a snapshot of finances at this time and then can project that forward through to an assumed mortality. We project to 100 by default, but really we can project to any age we want. And that shows how assets might grow over time. Obviously, there's a lot of uncertainty there, but how assets might grow over time, so we can consider the current liability to inheritance tax, as well as 5-year, 10-year, 15-year, 20-year projected liability to inheritance tax. So that's what was standard part of our review process and discussion. Equally, you know, we can speak to other professional relationships that might help with that situation, and you know, we're more than happy to do so. We're now equipped to say we're a full service IFA firm now, so we're equipped to deal with these wider planning strategies, and indeed a number of our advisors have been looking at this area for many years and advising in this area for many years. So absolutely more than happy to have either a high level chat about how inheritance tax might apply to your individual circumstances, or indeed consider formal kind of planning strategies and solutions and how they might be applied, and what benefit they might offer in the kind of short, medium and long term. And equally, you know, considering any strategies as part of a wider portfolio. And the key driver of all of this is just trying to be as tax efficient as possible. We're certainly not looking to kind of push the boundaries there, but there are lots of kind of easy wins from a tax planning strategy, you know, starting with things like using ISA allowances, using pension funding allowances, but then moving on to consider some options around inheritance tax mitigation as well. So that's me for now, and I'd be delighted to pick up with people in any more detail if necessary, but for now I shall pass back to Andy to see if there's any specific questions that have come through.
That's great. Thank you very much for that, Tom. That was really insightful. Very good. Thank you. Yeah, we've had a few questions in, some great questions. I'm going to start with one that I spoke to Fiona about. We'll give you a little bit of a break. Tom, you seem to be talking for a while there. This is something that Fiona and I mentioned the other day. There was a lot of speculation. The reason why our webinar was delayed till this week was we wanted to see what happened in the budget. Fiona, what happened in the budget?
Well, as far as inheritance tax is concerned, almost nothing. There was a little quirk in there. The inheritance tax rules are going to move people, instead of being treated by their domicile, will be treated by their residency. I don't think that's likely to affect too many of our clients who tend to be UK resident by default. But if you or your partner is non-domicile, it could create an issue, and you should speak to ourselves or to an accountant.
Very good. Another one for you to pick up here, Fiona, and there's a question from Phil, which is, are grandchildren classed as direct dependents for the residence nil rate ban purposes?
Yes, absolutely. In fact, you can go further down the line. You can have great grandchildren as well. The condition is more about direct than how close they are. So as long as it's in the direct line, then yes, the residence nil rate ban can apply.
Very good. I'm going to try and take a question myself to feel a bit of the burden. And this is from Akla. Forgive me if I've got that pronunciation completely wrong. But you ask, is the annual exemption for gifting £6,000 per couple? Which it is, and an added benefit is you can even go back 1 year and carry forward an unused year's allowance. So in theory, a couple could do £12,000 in the current tax year if they've not used this allowance before. And I would direct you to an article that we issued in our February client news called How to Gift Money and Reduce Your IHT Bill, which is still live on our website if you want to find out more information on that. One question here that we got in before. How do I decide the right age to start gifting? Tom,
I'll pick up on that one. That's an interesting question, a difficult question, and there's no right answer. We need to be conscious of timeframes, need to be conscious of health. So the younger, there are more options available to people in their 60s and 70s than there are in their 80s and 90s, for example. You know, I've had the instance in the past where someone in their late 80s has wanted to start talking about inheritance tax, and maybe with some health issues, then you are limited with respect to the options that are available to you there. So the 7-year is the high level kind of view that most people are aware of. If you make a gift, you're in this 7-year window where that gift, you need to survive 7 years for that gift to fall out of your estate. For individuals with limited life expectancy, the 2-year window can come in. But really, to consider any kind of strategies around inheritance tax, the use of our kind of cash flow modeling really helps to kind of illustrate different scenarios. So what if we were to consider gifting or setting up a trust in our mid-60s, in our mid-70s, and we can look at different scenarios through our cash flow modeling to say, well, this is option one, what does that look like, what are the potential tax savings, this is option two, and so on and so on. So that modeling really helps when people are maybe unsure about a course of action to take. That modeling can really help to illustrate different options.
Very good, thank you. Fiona, anything to add to that, or?
No, I mean, I think I would just say that obviously it depends on circumstances. You could pretty much gift at any time if you feel that your estate would benefit from it. But I think the key things are whether you want to have access and control, which Tom covered. And I think for younger clients, access and control tends to be more important.
Yeah. Good. Another question in here from Douglas. Does the 7-year rule apply to funds paid from an international bank account into a UK bank account? I presume if you're a UK resident, then...
Yeah, that's a tricky one. I imagine the way gifts are treated are the official definition is a transfer of value. So if you're transferring value out of your estate, and this comes back to Fiona's point about residency and domicile. So if the IHT assessment is now based on residency, if you're a UK resident, all of your worldwide, with the change, all worldwide assets would now be accessible to inheritance tax. Therefore, if you have an international bank account that you're transferring funds out of to another individual, this is me kind of imagining this slightly, but the revenue would view that as a transfer of value out of your estate, and that is the key definition. Has the value of your estate that is liable to inheritance tax, has that been reduced? If yes, that is treated as a gift. And
just looking at the addendum there, so we're talking about a non-domiciled individual. So in that case, probably not. However, the announcement on the budget regarding domicile, I have to say, it was literally a week ago. So we're still waiting for clarification on exactly what the rules will be.
So we might look at that one in a little bit more detail, Douglas, and come back to you if we may, if we find out anything more. I just want to touch on a question earlier, which was around the 7-year rule around pets and when does it start. So the 7-year rule does start from the date of the pet. And pets, if a pet, and correct me if I'm wrong here, Tom, if a pet is made in joint name, is a joint gift, presumably it's just attributed 50-50 to each individual, and it's so it's nothing to do with death of second spouse or anything else. It's the date the pet is made starts the 7-year clock, and gifts are either individual, or if it's joint, it's 50-50, a portion 50-50.
As far as
unless you've done it differently. Okay, perfect.
And the date of the pet is the date of the transfer of value.
Yeah. And another question here, which is one that we often see. What are the options with regard to main residence and IHT mitigation, which is something you were kind of touching on, Tom, but I don't know if you want to pick that up.
Yeah, so this is a common one, and we do hear occasionally of people, clients thinking that maybe they've gifted their main residence to children or trusts into some complex scheme. And quite often the case when we look into that notional gift is essentially disregarded. So you are unable to gift an asset, gift a property, and continue to benefit from that property. So you can't gift your home to your children and continue to live in it rent-free. That's the key point. I'll come into in a second. Because the revenue say if you gift a property, but continue to use it and benefit from it and live in it, they essentially disregard that gift. It's called a gift with reservation of benefit. So quite the property is an obvious one, but also if you had a Picasso hanging on your wall that's worth £1 million, if you have a letter on file that says I've gifted that Picasso to my daughter, it's hers, but it's staying in my house, but it's hers, the revenue would completely disregard that gift because you retain benefit from that asset. So when estates are dominated by property, there are quite limited options for planning, because the only really kind of black and white answer to that is we do come across it occasionally where people gift a property to their children, pass the property into their child's name, and then they'd have to rent it back from the children. So you have to pay a market rate of rent, which for most people are fairly uncomfortable to do that. But otherwise, if you're gifting properties, even second home rental homes, if you gift a holiday home but continue to use that holiday home every summer, the revenue would disregard that gift and still treat that holiday home as belonging to you. So we need to be, I'm sure it's a phrase some people have heard of, a gift with reservation of benefits. You can't gift something and continue to benefit from it.
Excellent, thank you. I think that kind of brings us to the conclusion of the questions, which is kind of perfect timing in terms of where we wanted to get to. If you just want to move it on to the last slide, Tom. So it just remains for us to say thank you to everyone for giving up the time to listen to this. Hopefully you found it insightful and helpful. Thanks very much to Tom and Fiona for their insights and the work they've put into this. As Tom has said, you know, there's only so much you can cover in a webinar, and then it becomes down to individual client needs, and these are things that we can pick up with people individually. Fiona wants to say something, so I'm going to let her very quickly go on.
I'm terribly sorry, but I should have made it clear at some point in this presentation that it is based on current tax rules. And obviously, if those change in the future, it's not our fault, and everything we said is probably wrong.
Therein speaks the compliance manager. We like
Yeah.
it. But finally, just if I can ask you, you will be asked to complete a really short feedback survey. Great to get your insights as to whether or not this is the right thing to be doing and what we can be doing more of to help support our clients. And it just leaves me to say thank you to everyone and enjoy your evening. So goodbye for now.